All right. So, hi everyone. Welcome to this session 7. As I said before, make sure that you stick around and you go to session 8 after this one, which is the raffle. You have to attend it or you will not get a certificate. And you make sure that you're completing those attendance and then the evaluations so that we have a record to give you your certificate. So with us today, this is Know Before You Owe, Higher Education Loans and More. And our presenter is Evelyn Castro, and she works for the state of, she is the first, our state's first student loan, I'm going to say the words right there because that's ombudsman with the state treasurer's office. And she assists students and parents with financial aid, guidance, and advocates for student loan borrowers by investigating, resolving, and addressing complaints related to federal or private student loans. So I think that's a big job, exciting. And I'm just going to turn it right over to Evelyn.
Awesome. Thank you, Kathy. Good afternoon, everyone. Like she said, my name is Evelyn Castro. I'm with the State Treasurer's Office. So I'm going to go ahead and start sharing my screen. And I'm going to share the entire screen. That way, later when we do the wheel, we'll be able to see it as well. Okay. Okay, so just want to make sure you can see the entire screen, Kathy.
Yep, that was a yes. Got it.
I can't see anything beyond this. Once I share it, I can't see anything.
There we go.
Awesome. All right. So the presentation today is Know Before You Owe. So I'm basically going to be going over a lot about student loans, the terminology, different things that one should know about their federal student loans, and in addition to their private student loans, and where to find scholarships. So, on. It's not. Okay. So as mentioned, I'm with the Nevada State Treasurer's Office. We have 2 locations. We are down here in Las Vegas, Nevada, inside the Grant Sawyer building, which is right off of Washington Avenue and Las Vegas Boulevard. And then we also have our office in Carson City, Nevada, inside of the State Capitol building. I myself am in Las Vegas, Nevada. And am available also for anyone that is interested in having like a one-on-one consultation or appointment regarding your federal student loans, or if you have students looking into financial aid, then I'm also able to assist with that. Just a little background about our college savings division. We basically administer different programs that help families and parents plan, save, and pay for a post-secondary education. Some of those programs are for younger children. For example, the College Kickstart, that's for kindergartners that start kindergarten in a public elementary school here in Nevada. So each child since the year 2013 received a $50 scholarship inside of a 529 account. So right now, the oldest child with the College Kickstart is in 9th grade. We also administer the prepaid tuition, which locks in today's tuition for the use of tomorrow. As we know, tuition continues to increase, and it basically increases at around an average of 4 to 6% every year. So with Nevada prepaid tuition, you're able to lock in today's tuition rates to pay for tomorrow. And just because it says Nevada on there, just want to clear things up, does not necessarily mean that that you can only use it in Nevada. It can actually be used anywhere in the nation and even outside of the U.S. where the FAFSA is accepted. And then I'm gonna say, because right now I honestly don't see anything other than my presentation. So if you do have any questions, feel free to either unmute yourself, or Kathy, if you'd like to just pause me for a bit and ask me, I'm more than happy to do that. But again, right now, all I see is my presentation. Okay, so back to what we offer. We also have Nevada 529 plans, the Governor Gwen Millennium Scholarship, which I know one of my colleagues is actually presenting on that currently as well. And then we have the Kenny C. Gwen Memorial Millennium Scholarship. That one is it always gets confused with the Millennium Scholarship, but the Memorial Scholarship is actually for college students who are in their junior and senior year and who are majoring in either elementary or secondary education. And that's a $5,000 scholarship that we award to 4 students every year. Currently, we have the applications open up until April 30th. We also have the scholarship database, which I will go over in just a bit. The College Navigator, it's a gentleman in our office who helps families and parents and basically anyone going through the college process navigate all the different things. And then my program, which is Student Loan Ombudsman. And in my program, I help educate high school students, families in regards to financial aid and how to use student loans as a very last option. But for those individuals who did fund their education with student loans, and I'm also available to help with any questions that they have regarding them. All right, so a little bit of facts about student loan debt. So total student loan debt in the US has reached $1.56 trillion. We have a total of 45 million US borrowers with student loan debt. In Nevada, approximately 349,000 borrowers owe student loan debt. And of those, we owe a total of $11.8 billion. One thing that I learned when I first started this position, as Kathy mentioned, I am the first student loan ombudsman for the state of Nevada. So I had to do tons of research to see where the problem was within Nevada. And one thing that I came across was that Nevada had the highest state of default rate. That was in 2019. So we were at 18.16%, and we were the highest one in the nation. That's not good at all. And basically what that led me to understand is that a lot of individuals are getting into student loan debt, not really understanding what this debt or what this loan really means. And honestly, I think, when you sign up for student loans, it is so easy to get a student loan, right? They don't really, especially federal student loans, they don't really do a credit check for subsidized loans. They don't go in depth in like other, big loans go into debt. Like if you go and buy a car, they're really going to look at your credit history. If you go buy a house, they're going to ask you for all types of information. And for federal student loans, they don't really ask for much, and especially students, they're asking them for their parents' income, which at the end of the day, when they're done graduating college, their parents' income has really nothing to do with how they're going to pay for that loan. So I just feel like a lot of individuals are getting into student loans, not truly understanding them. Of course, this is a fact from 2019, but we have to remember that in 2020, we went into a payment pause because of the pandemic. So since then, we really don't know where we stand yet. So that's why I made it such a big a responsibility of mine to go out to high schools, to go out to schools and really try to educate these students on what student loans or getting into student loans really means. Another fact about student loans, 1 of every 50 borrowers in Nevada owe more than $200,000 in student loans. 18% of Nevadans owe less than $5,000, and about 19% owe between $20,000 to $40,000. All right, so some things that students, have answered as far as like student loans is, they wish that they knew student loans wasn't free money. Some think that they're gonna get student loans, and maybe not have to pay them back. They don't understand that you have to pay them back and then they have to pay them back with interest. That they would have known how to finance college by using other options as opposed to getting student loans. A lot of students get into student loans not knowing what their monthly payments would be after they graduate college, or how long it would take for them to pay back their student loans. Sometimes, depending on the student loans that they get, they don't understand that some student loans, some of the interest that they're accruing while in college is getting capitalized. So what they're going to owe at the end is not going to be what they were told at the very beginning. And then a lot of borrowers still don't understand what their payment options are, or other benefits that are included with federal student loans. So that's kind of what I'm going to cover with this presentation today. So student loans, I don't want to speak bad on them because I know that a lot of us, needed to take out student loans in order to get into or, help us fund the career that we really wanted, right? Some of the careers that we want require certain degrees that are very costly, and we have to take out student loans if we don't qualify, or if we don't receive scholarships, right? So the only time though that you should take out student loans is after you've exhausted all other financial aid options. That includes scholarships, grants, work study, budgeting yourself so that you're not spending so much while you're in college. If you have to live at home instead of living, on campus, or, basically learning how to budget yourself, right, before you start taking out student loans to help pay for that. Whether you nor or your parents can afford the college tuition, or if, let's say, your college doesn't offer payment plans. Sometimes they do offer monthly payment plans. And of course, if you want to invest in your future and you don't have a savings account, etc., then student loans will come into play at that time. For anyone that's interested in learning about Nevada scholarships, or don't know where to go, we have our Navigate website. So if you visit navigate.gov, if you click on resources and then the scholarship database, a list of over 335 scholarships will populate. Those are scholarships listed, those are scholarships that you can find either like on a UNLV website, at the Public Education Foundation, just different places, right? We've just accumulated all of them, put them in one place, and it's just a really great resource for students in Nevada to go in, see what scholarships are available, see what they can qualify for. I always tell students, like, if you're going to apply for a scholarship, apply for all of them. Just because one offers $5,000 and one only offers $300, apply for the $300 one, because everyone's going to want to go for that higher amount. But if you qualify for like 5 $300 scholarships, you just you just got $1,500 of scholarships, right? So it accumulates, so it adds up. Okay, so first off, what is a master promissory note, also known as an MPN? That's going to be your student loan contract. That's going to be the legal document where you have promised to repay your student loan, and any accrued interest and fees to the lender or your loan holder. That could either be the Department of Education, if you receive federal student loans, or if you decide to take out private student loans, that would be a bank or credit union. And then in that contract, it actually details the terms and of the conditions of the loan, and basically any rights and responsibilities you have as a borrower or a cosigner. So who's a borrower, right? You are the borrower. Whoever is signing on to your student loan is the borrower. And that person is the one that is responsible for every dime owed on that contract, until it is fully paid off. And that means whether you have to pay off, in full all the interest that accumulates on the loan, or if you can pay it off, beforehand, etc. That's all, of course, going to be on the contract. But you will be, as a borrower, you're going to be the one that has signed on to the loan, and you're going to be fully responsible for that loan. Sometimes, of course, and I will also cover what a cosigner is. If someone else signs on with you, then they're going to be just as responsible as you are. So as a borrower, you want to make sure that you're borrowing responsibly. Keep track of how much you're borrowing, research starting salaries, know who your lender is, understand the terms and the conditions of your loan. Always make on-time payments. And then if ever you need to make, if you ever come, to like a financial hardship, because things happen in life. If you ever have a financial hardship or you just can't pay that loan, don't just stop paying it. Contact that loan servicer and ask and find out what options are available to you to help you during that time. Last thing you want to do is fall into default or delinquency with federal student loans, and I will go over the reasons why you want to avoid that. But you do want to make sure that you're borrowing responsibly and you understand exactly what you're doing, and at any point in time when you're receiving any type of student loan. Okay, so like I mentioned, a cosigner, basically the cosigner is someone who is credit worthy. Usually you'll get a cosigner when you're going to go out and get a private student loan. Because a lot of the times when you're a high school student, you're coming out straight out of high school, you probably have zero credit history. And if you don't qualify for federal student loans, then you'll probably want to get a private student loan. And if you can't qualify on your own, you would need a cosigner. And this is a person, like I mentioned, who's just going to be as responsible as you as a borrower, as far as repaying the student loan. So if the borrower, if the student or the main borrower stops paying on that student loan, the cosigner is just as responsible. So either they would have to start paying on that student loan, or their credit will also be affected if that student loan is not being paid for. Another thing too, so there's different options that you can look at when you're taking out private student loans and you get a cosigner. There are ways also to get a cosigner relief, meaning that after a certain amount of payments that you've made towards that private student loan, you're able to relieve that cosigner from your student loan. And so those are some things that you can always ask when you're shopping around for private student loans. Which is the cosigner release. So again, cosigner release releases the cosigner from responsibility of repaying the loan back. Most companies that offer a cosigner release allow it after they have received 2 consecutive years of on-time payments. Others may have longer terms for on-time payments before allowing a release. A cosigner release is not offered by all companies. Again, so you do need to shop around or ask to see if that's something that's being offered. If it's not, another option would be like to refinance a student loan and just remove that cosigner off later on. And I will cover refinancing in a bit. Again, I don't want to make anyone afraid about, of student loans, but you just want to learn how to responsibly borrow. So one question is, okay, so how much can you actually borrow? So it basically is determined by the loan type that you're receiving, and then the actual amount that the borrower is eligible to receive each year. And that's determined by the institution. The actual loan amount you're eligible to receive each year, maybe less than the annual loan limit, and the limits depend on what year you are in school. So whether you're a freshman, sophomore, junior, senior in college, whether you are a dependent or independent student. So basically, like if you're a student and your parents are not eligible for the Direct Plus loan, and you're still a dependent student, then you may actually be able to receive additional funds under the direct unsubsidized loan funds. Again, you want to make sure that when you're borrowing in student loans that you're not borrowing above what you need, and you should only borrow what your college costs. And what I mean by that is that when you're in college, as I mentioned, right, the school is going to determine how much loans you can actually receive. And that may be more than what your tuition is. They're not just going to only calculate tuition. They might calculate other things such as your books or other educational expenses. And after the loans have paid into you for your tuition and fees with the registry, like with the registrar's office, or the cashier's office, they may send you an additional check, either by mail, or they might automatically deposit it into your account. And those are just additional funds that you could use for other expenses. With any student loans, you can always refuse to accept that additional money. So if you don't need it, if you don't absolutely need it, then just refuse it. It'll go back, and you won't owe that amount of money. So don't take it as, oh, I'm getting this extra money, I'm going to go spend it on a vacation. Don't do that. All right, loan limits. Most private lenders have a minimum amount that you can borrow. Lenders can have a maximum annual or total amount you can borrow from them. The amounts can vary depending on loan, grade level, or the lender. Sometimes you may also be limited to borrow up to the school certified cost of attendance minus other financial aid that you received. This is just like a little cheat sheet that we've created, basically just to see how much your college would cost, right? So you want to know, like, sometimes students might be between 2 different schools or 3 different schools. And I tell students, a lot of the time, it doesn't really matter how much the tuition costs, because sometimes even the one that has a higher tuition cost may provide you with more financial aid, which would then make the net cost of college less, or more affordable. So you'll want to basically on this sheet, what I have is tally up, what the tuition and fees are, housing and meals, basically all the educational expenses, minus any scholarship grants, college savings that you may have. And then once you subtract those from each other, that's when you're going to know how much it is that you're going to need to come up with at the end. All right, so getting into federal student loans, when students apply for the FAFSA, they're going to be informed that they're either qualified for either unsubsidized versus subsidized student loans. So basically with subsidized student loans, the government pays for the interest while the student is in school, which means that the balance doesn't grow. So if they're told that their major is going to be $30,000 and that's how much they're going to get in student loans, then that's how much they're going to graduate with. And then once they graduate, they'll be once they graduate, they'll be responsible for the interest that starts accruing afterwards. And then this one, students do have to demonstrate financial need in order to qualify for subsidized student loans. Now, for the students that don't qualify for subsidized student loans, or they may even qualify for both, unsubsidized loans charge interest from the day that the loan is dispersed. So once they're accumulating that interest while they're in college, at the end, when they graduate, that interest is going to be capitalized at the end of their loan. So now, like if let's say that they were supposed to take out $30,000 and interest is going to be an additional $8,000, right, after they graduate college. Now their principal balance becomes $38,000. And now they have to pay interest on $38,000. So that's the difference between both of them. So I always tell students, if you have the option between both and you can only, and you have the ability to only use one, definitely use subsidized, just because you're not going to be responsible for that interest that's being accrued while you're in school. Interest rates. Basically, anytime that you borrow money, you're going to pay interest rate, right? So interest is paid to a lender as a cost of borrowing money. It's calculated on a percentage of the unpaid principal balance. They could be either fixed APR or variable APR. If you're going to borrow federally, they're going to be for sure fixed APR. That means that the rate does not change over the life of the loan. And if you do choose to go private student loan, you may be either in a fixed interest rate or a variable interest rate. And if you have a variable, that means that basically it's a floating rate. So it changes. It's going to change periodically over the life of the loan. And how it's changing is based on what is happening in the market. So how are interest rates determined? So for federal student loans, they're set each year on July 1st, and it stays the same through June 30th. It's based on high yield of the 10-year U.S. Treasury note, and then a certain percentage then gets added by Congress. So it's all done on a federal level. Private student loans, on the other hand, are competitive, and they may change monthly as the market changes, like I mentioned, because they might offer you only variable interest. It is going to be reflective on your credit score and your income, and see how much it is that the borrower would qualify for. So sometimes they may promote a very low interest rate, like, oh yeah, student loans at 2 point something interest rate. But again, that depends on what your credit history looks like or your credit score is. And that's what's going to affect the interest rate you qualify for. And then again, borrowers can choose from variable or fixed interest rate. Usually when you ask for a fixed interest rate, it's going to be higher than a variable interest rate. So that's just something to keep in mind. They might start you off at a low interest rate if you choose the variable, but again, that's going to fluctuate throughout the life of the loan. And why do interest rates matter? And the reason is, so let's say that you borrow $30,000 at a 6% interest rate with a 10-year loan term. That means that you will pay almost $10,000 in interest. So in order to borrow $30,000, it's going to cost you $10,000. So basically, to borrow $30,000, you're going to pay almost $40,000 on that loan. Now, let's say that you borrow the same $30,000 again with the 10-year loan, but then your interest is only 5%. That means that it's only gonna cost you a little bit over $8,000 in interest. So the lower the interest rate is, the more you're going to save, right? In total life. So if you were to borrow $30,000 and then there's an interest, and then you're paying interest of 5% on 10 years, then you would save yourself a little bit over $1,700 or almost $1,800 on interest. These are just the current federal student loan interest rates, if anyone is wondering. So on or after July 2022, and of course before July 1st, 2023, for those that are in undergraduate or undergrad students, direct subsidized loans and direct unsubsidized loans are at 4.99%. And again, these are fixed interest rates, meaning they're not going to change for the life of the loan. And then direct unsubsidized loans for graduate or professional, they're 6.54%. And if you decide to get direct plus loans, which are for parents or graduate professional students, it's at 7.54%. Capitalization, I just kind of covered that just a while ago. Basically, it's any unpaid interest that accrues until the loan is in repayment or deferment status. So these are for unsubsidized loans. Any unpaid interest basically goes to the back or to the back of the loan. So if you owed $50,000 and now you accumulate $12,000 in interest, now you owe $62,000 as a principal balance. So what that generally means is that you're going to be paying more in interest because now you've borrowed more, right? Because now you're paying interest on a higher amount. An example of capitalization. So let's say that you borrowed a $10,000 loan with a 6.8% interest rate. Interest accrues at, let's say, at a daily of $1.86 a day. If you're on deferment for 6 months and you're not paying off the interest as it accrues, and deferment means that you're not making any payments within those 6 months, then the loan will accrue interest totaling $340, right? At the end of the deferment, those $340 are now going to be added to the principal. So now, instead of only owing $10,000, now you owe $10,340. So now this now causes that the interest is going to increase every day. So instead of the $1.86 daily, now you owe $1.93 per day for borrowing that amount and having that interest capitalized. Other fees that you should be aware of. There's a loan fee or like an origination fee. So if you're going to be taking out a loan, they're going to charge you for taking out that loan. It's a percentage of the total amount you're borrowing. So it's the gross amount. And the loan fee is deducted proportionally from each disbursement of your loan, which means that it reduces the actual amount you receive. The specific loan fee that you're charged will be included in a disclosure statement. So again, in your contract, and you'll be required to prepay the gross amount. Now for federal student loans, this is the loan origination fee that they come with, and that's for direct subsidized and direct unsubsidized loans. How does a loan term affect your loan? So the loan term is basically the life of the loan. It's the repayment schedule, right? How many years you're taking money out for. And it's basically the time that you're given to pay back the amount that you borrowed, plus the interest or any fees that you've accumulated on that loan. So the longer the loan term, the longer your loan accumulates interest. So the more money you're going to end up having to pay. So I put 3 examples at the bottom. Example 1, if you, let's say, get a 10-year loan term, your monthly payment is $104. Total interest is $2,454. That means that the total amount that you're going to repay is going to be $12,454. And again, this is if you're borrowing $10,000 at a 4.53% interest rate. Example 2, at a 15-year loan term, to borrow $10,000, I mean, you're going to end up paying $13,797. If you're borrowing a 7-year loan term, then again, you're going to borrow less than if you were going to borrow at a 15 or a 10-year loan term. So the faster you decide to pay off your loan, the less interest you're going to be paying. As far as calculating like your monthly payments, right? So suppose you borrow $30,000 with a 10-year loan term, and I'm just going to go by like different interest rates. So one example, if you have an undergrad federal student loan at a 4.53% interest rate, your monthly payment would be about $311. Total interest that you'd pay would be $7,362. So total repayment amount is $37,362. Example 2. So again, this is just basically on how much you're borrowing on the 10-year loan term, and then depending on how much that interest rate is. There is a calculator. You're more than welcome to take a screenshot of this, but there is a calculator on studentloanhero.com, and if you just put in like how much you're planning to borrow, what the loan term is going to be, what the interest rate is that you're going to receive, it'll actually calculate what your monthly payment would be. Okay, so federal versus private student loans. Federal loans have fixed interest. Like I mentioned, they are usually lower than private student loans. I will say private student loans are able to, they're able to, they're able to let individuals borrow at an interest rate of up to 16%. So that's very high for student loans. Most federal student loans do not require credit check. Credit check would only be required if you are borrowing for a plus student loan. Most federal student loans do not require a cosigner. The government may pay for the interest, like I mentioned, on subsidized loans while you're in school or during some periods after you're able to demonstrate financial need. Federal student loans offer flexible repayment plans, so there are a lot of benefits associated with federal student loans as opposed to private student loans. Federal student loans can postpone your loan payments if you're having trouble making payments. Certain jobs may be eligible for federal student loan forgiveness when certain conditions are met. Again, these are things that are benefits of federal student loans as opposed to private student loans. So one big example, when the pandemic occurred, right, and everyone went into a payment pause, a lot of individuals were wondering why they weren't in a payment pause, and that was because they had private student loans as opposed to federal student loans. So anyone that had federal student loans, they went into repayment pause. I hear a lot of individuals getting loan forgiveness. That's because they're in federal student loans or they have federal student loans, not private student loans. So you really want to make sure if you're deciding, as to which one you should go for, federal student loans always will have better benefits than private student loans. But again, it's just every individual's need, right? What they can receive or what they can't receive, or what they qualify for. So every individual is going to have a different circumstance. But federal, in my opinion, would be a better way to go, because if you ever have financial hardship, or if you choose, if you know you're going to borrow a lot and you know that you can maybe get, forgiveness by working for the government or working as a teacher, then maybe federal student loan is, the better option for borrowers. So what would you be giving up and gaining? If you find yourself in a situation when borrowing privately would actually be more beneficial than borrowing federally, then look for other benefits in your terms and conditions. But the best private student loan lenders will offer low interest rate loans with your choice of a loan term, flexible repayment options, death and disability discharge, at least 6-month grace period, right? Because a lot of private student loans, they require payment as soon as they disperse to you. So if you can get one that will not require repayment until after you graduate, that would be awesome. 25% auto pay, interest rate deduction. So like if you what's it called? If you choose to do like an auto pay, they'll actually lower your interest rate. Forbearance for economic hardship, cosigner release, and then you can also consider other options aside from student loans depending on the amount needing to borrow. So there's other options, maybe you put it on a credit card, or it just depends, right? It depends on how much you're needing to borrow. Loan discounts. So private lenders will sometimes offer a variety of discounts on terms of the loans. One of the most common discounts is in the interest rate reduction. So if you enroll into auto pay, selecting interest only while enrolled in school, being a member, having other products with them. When's the first payment due? So this depends on your contract. Some private lenders will require payment as soon as they disperse the money to you. Some may require your first payment as soon as you graduate. Other lenders may even offer the grace period, like I mentioned. And basically, grace period is any time given before the first monthly payment is due. Not all loans offer grace period, and a grace period can be anywhere between 6 to 12 months after your graduation. And it's basically they're designed to give graduates a time to find a job. For federal student loans, once you graduate, drop below half-time enrollment or leave school, your federal student loan goes into repayment. However, if you have a direct subsidized or direct unsubsidized or FFEL loan, you have 6-month grace period before you are required to start making regular payments. You'll have a 9-month grace period if you've got a Perkins loan, and then those that have plus loans go into repayment as soon as the loan is fully dispersed, which means once it's paid out. But if you're a graduate and professional student plus borrower, you will be placed on an automatic deferment while you're in school and for 6 months after graduating, leaving, or dropping below half-time enrollment. Again, remember, you can borrow less than your school offers, and you can request more funds later if you need to. The most important things to look out for are the disbursement dates. That's the first time that you're receiving funds, the amount that you're borrowing, so the total amount that you're going to get on each loan, the interest rate that you're borrowing at, the benefits that are associated with your student loan, and then when your first payment is due. Deferment and forbearance. This is basically if you're ever in financial hardship and you need to pause those monthly payments, you can call your servicer, your lender, and ask them to be placed on a deferment or forbearance. Basically, these are just times that you're not paying your loan. However, depending on the type of loan that you have, you may still be accruing interest on your loans. And again, that interest then gets capitalized and you're going to owe a higher amount. Loan consolidation. So if you have multiple federal student loans, you can actually consolidate them into one so that you're not making payments on different loans. There are some pros with this and there are many cons with this. Currently, right now, they are asking for a lot of borrowers to consolidate in order to qualify for like public service loan forgiveness or the IDR forgiveness. Now, beyond the waiver that they have, if you already have, like if you're in PSLF or you're being trying to qualify for public service loan forgiveness, I would be very, very careful with consolidating, because when you consolidate on the regular terms on the public service loan forgiveness, that means that your clock restarts on the payments. So again, this is something, if you're planning to do it, just really check on where you're at, what you're planning to do in the future, and whether it's going to affect you. Refinancing, if you have federal student loans and you're wanting to get a new interest rate because now you have incredible credit and credit history, you can refinance your student loans. The only thing is that you're basically, if you have federal student loans, you're going to be refinancing into a private student loan. So you might lose out on federal protections. And refinancing, like if you have a private student loan, if you have that cosigner, this might be an option if you want to remove them from that private student loan as well. So as I mentioned, right, Nevada, we were at the highest rate of default. So what can actually happen if you fall into default? If you fall into default, that means that they can accelerate your loans, which means that you're going to owe your entire unpaid balance immediately. The borrower can no longer receive deferment or forbearance or lose eligibility of other benefits, such as choosing a repayment plan. The borrower will lose eligibility for additional federal student aid. It'll be reported to the credit bureaus. They can withhold your tax refunds or federal benefit payments. They can garnish your wages. They can even garnish your Social Security. Borrowers may not be able to sell assets such as real estate, so they might even put liens on your property. Borrowers may be charged court costs, collection fees, attorney fees, or other costs associated with the collection process. The school may withhold the academic transcript until the defaulted loan is satisfied, which means that they may also keep certain licenses from you in order to even work. So going into default with federal student loans is the last thing you want to do. There are different types of repayment plans, and I'm showing I'm a little bit low on time, so I'm not going to go under each one of them. But if you have questions about any of these repayment plans, please give me a call, and I'm more than happy to go over them with you. But there are different repayment plans that actually can lead towards forgiveness. One thing I will say about these repayment plans is that you got to remember, right, that if you're in a repayment plan and it doesn't lead to forgiveness, etc., then you are still accumulating interest, even though your loan payment is very low, or they might offer you a very low payment. Interest is still accruing every month, no matter how much your loan payment is. So that's just something to always keep in mind. There are options though, if you're coming, if you have a financial hardship, there are options where they're looking or they're considering your income in order to lower your repayment plan, in order to lower, sorry, your monthly payment. Another thing too is that if you are wanting to seek public service loan forgiveness or other type of loan forgiveness, some of them do require for you to be in certain repayment plans as well. I'm just going to cover a couple of other benefits associated with federal student loans. So one that we hear a lot about is the public service loan forgiveness, meaning that if you work for the government, you work for, and that's federal, state, local, tribal. If you're a teacher and you're working for CCSD, that's considered a government employee. Or if you work for a not-for-profit organization, then you can qualify for public service loan forgiveness. To qualify, you have to work full-time for the agency or organization at least 30 hours per week, have direct loans. If you don't have direct loans, then you would have to consolidate them into federal student loans, your federal student loans into direct loans. Again, when you consolidate, that usually starts your count back to zero. So if you have 9 years worth working, for the state, et cetera, and you consolidate into direct student loans, you've basically remove those 9 years and you start back up at 1. Right now, they do have waivers going on, so that could be waived. But there are also, these are things that are being fought in court also. So I don't like to push the waivers too much, just because if they choose to not and you've consolidated, then you're going to be, you're out of luck on that. You have to repay your loans under an income-driven repayment plan, and then you have to make 120 qualifying payments, which adds up to 10 years. That's why I mentioned the 10 years. And you can't send 1 month and 3 months worth of payments and be like, oh, I just added 3 months to my account. No, they actually count monthly payments, so you can't pay in advance. Borrower defense. So basically, under the law, you may have a borrower defense to repayment, which is a legal ground for discharging your federal student loans if your school misled you or engaged in other misconduct or violation of certain laws. If the U.S. Department of Education approves your application, then they can actually discharge your entire loan. Trending news right now was Sweet versus Cardona. We saw thousands of students being discharged of their loan because their schools did mislead them. The Biden administration student loan debt relief plan. Basically, right now, this is blocked. This is the whole announcement that they made last year in August, up to $20,000 in debt relief to recipients. But it is currently blocked, and it is being right now reviewed through the courts. So this is, more to come on this. I'm not going to get into it in detail. But if you do have questions, or if you did submit an application, they're not asking for borrowers to resubmit an application. If you submit an application, they're holding those applications at the Department of Education. So once they are given the green flag to actually discharge, then they will go through those applications. Other forgiveness and cancellation discharge options for federal student loans. Basically, there is a closed school discharge, Perkins loans, cancellation, discharge due to death, discharge due to bankruptcy, very rare, the total permanent disability discharge. There's different types of cancellation and forgiveness or discharge options. Again, you can learn more by visiting either studentaid.gov or contacting me. Before getting into student loan debt, you want to estimate what it will cost you to attend the school of your choice, borrow only what you need, research your earning potential, and make sure your student loan will be a manageable burden. Think long-term, consider what your month-to-month bill will be and of what you're going to borrow, and then weigh your loan options. So just always remember that. One might offer you, or each might offer you the same amount of student loan, but you might end up paying back more depending if you have a higher interest rate with one or the other. I always encourage, encourage students to apply for the FAFSA to find out what they qualify for, because you'll never know unless you find out, right? And the worst thing they could do is say no. Again, if you have any questions, you can contact me. That is my direct phone number. That is my email address. You're free to take a screenshot of this, or you can also visit us at navigate.gov to learn more about any of the other programs that I mentioned early on. Again, I couldn't see the screen, so I'm not sure if there were any questions. So I'm going to stop sharing my my screen. Okay, I know we have like 2 minutes left. I'm not sure if you want to do the raffle now or if there were any questions. I can't see the chat. Oh, there you go.
Yeah. So Evelyn, I have a wheel up. I tried to paste in the names for you, but
Okay.
they paste in funny to the wheel. So I have one up.
Okay, perfect.
Okay.
Yeah. So just so everyone knows, our office is gifting 2 $15 iTunes gift cards to 2 participants that joined this meeting today.
Oh, nice. Okay. So I'm going to actually pause let me stop the video really quick.
Okay.
1 second. Let me stop share for a minute so I can stop the recording. Thank you.